So, as we've been telling you, the Senate has a compromise housing bill of sorts. It's aimed at helping millions of people avoid foreclosure. Would this deal between Democrat and Republican lawmakers be possible at all if it wasn't for an election year?
And what does Britney Spears think about it? No, I just wanted to throw in her name.
I love it.
I just had to.
What a novel approach.
Let's ask our Fox panel. They're cuter than she is, including Biz Radio Network host Mike Norman. We have Peter Schiff, author of Crash Proof, David Darst from Morgan Stanley, and Joran Brook from the Ayn Rand Institute. Mike, what do you think as we pose that question about the election year, the Senate, and the involvement, what they're trying to do?
Look, I think it's clear that the election gives more impetus to this thing. However, things are bad, and I think there would have been an outcry either way, and I think we would have seen something happen just because a lot of people have been affected. It's spilling over into the general economy, and people are asking for some kind of relief here. So there's no question that the election provides an additional impetus to this, but I think something would have happened.
Even though your city is doing very well today and yesterday, it had quite a pop.
Leading it. We got to look at stuff like that because it is a leading indicator.
But because it's election year, Peter, isn't there a problem of Congress going too far? And I mentioned to our last guest this provision that would allow judges, for example, to change the terms of a contract between a borrower and a lender.
Well, they always go too far. I mean, they shouldn't be doing anything. But, one of the problems with all the bailouts now on Wall Street is it provides the politicians with the fodder that they need. Hey, if we're going to bail out all these millionaires or billionaires, what about the little guy? And it's giving them ammunition, and I wish the government would stay out of the whole thing. We have to let housing prices fall, but the government doesn't want to let it happen because it exposes trillions of dollars of bad debt, and they want to try to bury it under the rug.
David, they're talking about, Peter's just talking about bailing out the big guys, etc. You at J.P. Morgan could be considered among the big guys. When you see all of that effort on behalf of the Fed to help out the Bear Stearns of the world and cut deals just so that we have an orderly unwinding of a position like that, is it fair to say, well, wait a minute, can we also help out Americans?
Liz, you and David have brought up on the show countless times, we have 8.8 million people whose homes are worth less than the mortgage. That's so-called upside down or underwater. That's 10.3% of all households, which is double what it was a year ago. So you are in a very crucial time. Don't forget, we've had a once-in-100-year rise in house prices in the United States, and we're now having a once-in-100-year fall in house prices. So you're going to have radical solutions called for. It is an election year that brings everything under the spotlight. You've got the Republicans even letting Jim Lockhart open things up over Fannie and Freddie, letting them increase their leverage. We don't need increased leverage. We're deleveraging right now. Letting them increase leverage and letting them reduce the amount of this super regulatory surplus capital that they had to have. Giving them amount to lend another $200 billion. Then you've got the federal home loan banks. So you're going to have many different solutions here.
But, Joran, the problem is that what Congress does is it paints with a very broad brush. And these problems are specific. In fact, David Malpass from what was Bear Stearns, I don't know what it will be tomorrow, said this morning that you have 4 states, California, Florida, Ohio, and Nevada, that are hit particularly hard. If you take those out of the whole picture, the situation is pretty normal.
Atlanta, Portland, and Seattle are actually in positive territory.
That's right.
Charlotte's in positive territory, David.
So, Joran, is there a problem with painting with too broad a stroke here?
Look, there's a real problem out there. Let's not minimize the problem. But anytime you get Democrats and Republicans talking together and agreeing, we should all be very scared. Nothing coming out of this is going to be good. It might, coat some stuff with sugar in the short term, but long term, this is going to just reinforce all the bad habits that created this crisis to begin with. This is a crisis created by the bad incentives provided by those guys in Washington who are trying to solve the mess that they created. The best thing they can do is step back and get rid of all the incentives that exist out there that they provide for people to buy homes they can't afford.
This was a
crisis. People are buying homes they can't afford. People are buying homes they can't afford because people like Mike and our politicians want to subsidize them to buy these homes and then get them in trouble.
Mike, but Mike, can you not then say that at least if the Senate and the House are able to bring together some counseling. I know that that's one of the things, and you could raise your eyes. It's so touchy-feely California, but getting the counselors together with the lenders and the homeowners to make something happen.
Not the role of
Why is that a bad thing?
It's not a bad thing, and it's precisely
it's not the role
what
of government to provide counseling about bad investment decisions.
Hold on, Mike. Go ahead.
Paul Volcker, your esteemed former Fed chairman,
he was ours. He wasn't mine personally.
Him, but I mean, he once said, "Look, the markets are wonderful, but they are not God." This idea that you could just leave it to the market and have it, the whole thing get worked out is ludicrous. I mean, we tried that in the 1930s. It was called depression. This is precisely what government is for, to step in at a time when we are potentially facing a huge economic catastrophe.
Peter, the government created, but
any economist will tell you the Great Depression was created by government, Mike.
Hold on, Peter, go ahead.
It's not so much that people were buying homes they couldn't afford. They were overpaying for homes. Prices were driven by the low interest rates of the Fed and these lax lending standards.
There's your free market, Peter.
No, it wasn't a free market. The Fed was setting interest rates below where the free market would have set it. People overpaid for these houses. You had people in California paying $600,000-$700,000 for $200,000 townhomes. That's the problem.
David?
We've gotten up to 70% home ownership rate in the United States. It's a big move up from 60%. The last 5, from 65 to 70. It's very easy to talk about it in clinical terms here, but for many folks, this is their dream. This is a part of the stability of this country that makes us the envy of the world.
All right, that's the last word of this particular session. The R word was used for the first time.
So yesterday we had this gain of nearly 400 points. Huge start to the second quarter.
Today, guess what happens? The Fed chairman talks. Well, he used the R word. That's the problem. He said recession, but in the context of saying he still doesn't think we're in it, but who knows? We're in a slowdown, and that's what happened to the market. All the indices are down, except for that Russell 2000, which is still a little bit in the plus side. But again, the question is how much of what Bernanke said affected the markets today.
Could the markets really be shocked anyway? A million people have been saying that we're either very close to or perhaps dipping the toe into the recession. But as the Senate strikes a deal to help the ailing housing industry, we're looking at stocks that seem to be turning to the red. Now, here to make sense of all of this is our all-star panel once again. And David Darst, I'll throw this to you once again. Of course, David Darst of Morgan Stanley.
Nice to see you, Liz.
Why do we have an up day of 400 points and then another down day today?
Liz, this is your classic. It's a very emblematic of a very late stage market. This up 4% moves. We've had 3 of them now. March 17th may very well have been the low. The market is in a classic multiple personality disorder kind of phase right now, in which one day the system's going to break and the next day it looks like we've passed the worst and we're still not out of the woods. I have said that this is a patient in the hospital who's sick and we're now on Jell-O, okay? We've gone from liquid food, we're not on solid food yet.
That's a good sign,
That's
though.
right.
It's in the right direction.
It's in the right direction, but we're by no means, David and Liz, out of the woods right here. So this is a classic up 400, down 63. Up 63, down 300.
But I listened to Mike Norman, who was pretty bullish up until now, saying you sounded to be agreeing with Bernanke that, look, we've still got a few months, if not a full quarter and a half, to go before this thing turns around.
It doesn't matter if Bernanke says we may be in a recession now. We got to think about the market. The market looks ahead. I think probably March 17th, as David said, the Fed came in and did something revolutionary there. I think with that whole Bear Stearns and the J.P. Morgan said, look, we're putting a bid under the market no matter what here. And that turned us around. And we're going to have this, market volatility a little bit back and forth. Look, the 391 points up the other day, that represented the best start to a first quarter in 70 years.
Yes, 70 years.
70 years. So you have a little bit of a pullback. I think we're getting better.
Brooke, when you see what we saw yesterday, which was that spectacular start to the second quarter, and then a pullback today, does that surprise you? Do you see that as just another bear market rally or the start of something new?
No, I mean, this is just an example of the uncertainty that's out there in the market. There's still a lot of good news, but probably even more bad news still to come. And the market's trying to sort this all up. This is the kind of volatility you would expect in a time of uncertainty. Nothing more.
I went back, Peter Schiff, 4 years in Factiva. I can mention Factiva because it's a Dow Jones product, and News Corp owns Dow Jones. The fact is, 4 years ago, you were touting $100 oil. This was a couple of years before Goldman Sachs said it. You turned out to be exactly right. Now, that's why folks have to listen to what you say. Nevertheless, you have been bearish for so long. What's going to turn you around?
I don't know. I mean, I think it's going to get a lot worse before I get turned around. But I'm still bullish on oil. I'm still bullish on, gold is up $25 today. It was down yesterday. I'm still bullish on a lot of the foreign stock markets. I think there's a lot of legitimate growth overseas. But we still have a lot of problems. And, I don't think the bottom was in March. I don't think the Bernanke put is going to hold the lows. I think the market is going to go lower. We've got some serious problems we have to deal with. When we finally deal with them, when it really does hit the fan, when the market does really wash out, then maybe I will be able to get bullish on U.S. assets and U.S. economy. But I think, unfortunately, that day is a long way in the future.
When you had a day like yesterday when UBS comes